All right, so we finished the week on the high note after a good earnings response, a good market response to Apple's earnings overnight, and then a good response to the jobs report here this morning, even though the jobs numbers were not so great and lower than expected, and it kind of reflects, some quite a few worsening economic indicators we've seen here lately. Economic surprise index finally breaking into negative territory. Citigroup Economic Surprise Index. Still, we actually had a pretty good day. The question is whether it was good enough the past couple of days to offset the weakness we saw earlier in the week and really start a new trend. Right, we've been pointing towards the beginning stages of a new intermediate run for the past couple of weeks. After that, expiration double cluster low point from a couple of weeks ago. Well, the last 10 days we've been just kind of trying to get going and starting this new run. It's taken a while, and today was a really good day that really should have been like, okay, we are reversing the trend, and for all intents and purposes, they very well could have, and we will, and I expect that it will ultimately. But in the course of this 10 weeks, and especially this week, there's a lot of factors that have been cropping up that just increase the probability that we're going to get a failure here at the moving average, as you'll see, and potentially work our way down to a new leg lower to the downside. A lot of just big red flags. Now, again, I expect that we'll bounce. I expect we'll continue to move higher, that we'll be fine. But I'm going to show you kind of what we need to see in the next couple of days to really just overcome all these red flags. Otherwise, on Monday and Tuesday, if we don't, and we fill in today's gap, and then some, then we might have a real significant change in attitude going into the rest of this month and into June, the rest of this quarter. So we'll break all that down, what those red flags are, what's driving, where the rotation's going right now. And then our trade idea is a stock that had a, kind of an interesting response to its own earnings, big up and down the last couple of days. We'll talk about how to trade that. So let's go ahead and get started. Today is Friday, May the 3rd, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before you get going too far, I invite you to subscribe to our YouTube channel, this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video where I review all the old trades. See whether we should stay in them. We got out of a couple today. We also put on today's trade already before the market closed. Come down to the bottom. If you'll let me click this heart. It opens up this tab. I hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. I hit that like button there as well. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. Help us get to our goal of 100 likes on these Market Outlook tweets. All right, let's go ahead and get started here with looking at the S&P 500 with the market forecast indicator. As you can see, a nice little rally. Oh boy, we stopped just short of getting a bear tag today, just off the highs of the day. At the highs of the day, we did have a bear tag. Bear tag on here. Intermediate line rising, hence the light green shading. Not above the 50th percentile yet, which was what turns it to dark green shading. We don't even have a yellow line. That's when you get the actual bear tag. We don't have that yet. Short-term sentiment's positive. We did jump back into bullish territory on the near-term line. The momentum line, you can see, jumped to extreme highs, coming from extreme, in 2 days, we've gone from extreme lows to extreme highs. Now over here, we went from extreme lows to extreme high in 1 day. And it was about the lowest low you can get, 0.27 up to 98. So here we were just barely extreme low, and here we're just barely extreme high, and it took 2 days. But still, a pretty good, strong move in 2 days. The near-term line most likely will follow suit, right? It typically follows where the momentum line goes, especially if the momentum line actually gets into the upper reversal zone. It's not too often the momentum line, like here, gets into the upper reversal zone, and the near-term line doesn't, right? This is kind of a rare situation here. for the S&P, and that's not the case. Especially in this case, the intermediate line is just so bullish. Obviously not the case now. So more than likely, your near-term line is going to make its way into the upper reversal zone, which is good. That will support a new bullish posture. We are above the moving average. You need to get further. We need to get like 2.5% above so we can really get that bear tag, which we most likely will get on Monday, barring a big drop on Monday. If we can close above the moving average, because moving average will actually fall down some more. So assuming we are flat or even slightly positive, we'll get that bear tag on Monday. And again, like I said, it would be ideal if we were to get closer to this 2.5% mark. So that's the S&P. The NASDAQ, which was led higher by the Apple earnings, did get the bear tag. So this is very positive. Again, short-term sentiment very similar to the S&P, and we're barely above the moving average. Now, this isn't the best, right? You can see when you get the bull tags, when you're just barely below the moving average, they tend to fail. Like instead of reversing the trend, they bounce, right? It kind of fails the trend reversal and we move higher. Well, here it's the opposite. We're getting a bear tag, but we are barely above the moving average. So we're not out of the woods yet, even though it's got that bear tag there and looks great. We're not necessarily like free now that we can really take off with a reversal. There's still a pretty decent chance. Again, I don't think it's a high probability, and I'm not expecting it, but there's a decent chance that this can fail. We can move back lower, just like these failed, and we move back higher when you got the bull tags. If you look at the Dow Jones Industrial Average, the momentum line did not get into the reversal zone. We did get a bear tag on this as well. Market sentiment still falling. Intermediate line is a lot lower, so it's nowhere even close to even getting out of bearish territory, much less getting to the getting up into the upper half of the chart and get the green shading. Again, we are barely above the moving average at just 0.25%. So it's great. It's a good sign. Bear tags are good because almost every intermediate run starts with one. But again, it's kind of like they fail when you just barely get above the moving average. It tends to have it's like with a smaller range, it's likely to fail. Right now, granted, it's a smaller range today because most of today's move occurred overnight. But still, it's a smaller range because that's where all the volume is. The volume is in this 290 points, not in the points that occurred pre-market or after hours last night. If you look at the Russell 2000, you can see again bear tag. That one looks good. It's again below average on the range because most of the range occurred overnight. Momentum line had gotten to extreme highs yesterday. The near-term line followed suit, just like you expect the others will. We're still only 0.5% above. Again, when you just barely get above or just barely get to or just slightly below, that's when they tend to bounce instead of break through. So again, still a pretty decent likelihood that we will bounce down from here instead of breaking through. But again, I expect that we'll start a new trend, a new intermediate trend of dark green shading and a green line, but we just have to be aware over the next couple of days of the potential of that bounce back down. This is what the weekly chart looks like. Your short-term sentiment rebounded from some pretty bearish lows there. Now the question is, now that the near-term line's in the reversal zone, bullish territory, and not in the reversal zone, the momentum line's definitely not in the reversal zone. So how likely are we to actually get a new bullish move, or are we setting ourselves up for a bearish near-term peak? So that's something to keep an eye on. Again, last time, usually when you're strongly bullish, usually that first move doesn't really start the decline. You can see even over here that when we were bullish, the first bearish drop in short-term sentiment, you actually had a couple of weeks, just like we just had now, of a rally before you actually had a little bit more of a drop. If you go back over there to this bullish move, we actually had a big short-term sentiment drop here, and we just continued higher. Then we had another short-term, after a long extended run, we had another short-term short-term sentiment drop on the weekly chart. And then again, that did not start the decline. It didn't start until a little bit later. We rebounded for 4 weeks there before going sideways the rest of the year. So, again, we're rebounded already 2 weeks off that short-term sentiment low. The question now is, how far up will this short-term sentiment go? Will it get all the way up into a bullish territory, keep the intermediate line above market sentiment and keep it bullish? Or are we going to fail here, right? Again, Will the bull bear tag on that daily chart lead to a drop on the near term line here? Again, I don't expect that to be the case, but again, we'll know very quickly on Monday and Tuesday whether it will be or not. But that's, we just need to be aware that this week's move, as great as it's been, has not erased the red flags that are still there that suggest things might not be as bullish as it seems. If you look at the 3 green arrow chart, the other weekly chart that we look at. Let's look at the other weekly chart here. Again, you can see the transition candle. Again, another red flag is that it was not really a big bullish candle. Now, it wasn't that bearish either, but if you look at next week's Hakinyashi candle, we're most likely going to start right around 50.90. Well, we're trading at 51.27, so we're trading at 30 points up above that. That's not that big of a bullish candle, so we're not going to start off like this with a very strong move to the upside, because this candle over here, the week of October the 30th, was a strong bullish candle. So it's a much different situation than what we're getting on this transition candle. It generally means that we're more than likely due for another transition candle. And when we get multiple transitions, instead of reversing, it tends to continue in the move. So same thing over here. We had multiple transitions, so instead of reversing, because this transition candle was not a bearish candle, that at least strong bearish, so it led to another transition candle that instead of reversing, we just continued. So now the question is, are we going to get another transition candle next week, especially when there's really nothing major until the CPI the week after? Are we going to, instead of reversing, are we going to continue, right? Again, another red flag that we need to be aware of. I expect that we'll reverse, because that's what you expect. Until it doesn't, that's what you expect. But we need to be aware of that pattern that's there. Let's look at the 3 green arrow charts. Again, 3 green arrows on the S&P 500 here. On the Qs, you can see, well, we're pretty close to 3 green arrows. Like we will be above it, by Monday. But we did get 3 green arrows today on the Qs. We did get 3 green arrows on the diamonds and the IWM. So, dark green shading. Now we don't have a green line, but green shading. And just to kind of give you an idea of what it looks like when you get that first 3 green arrows here. Here, it's because we were so bullish, we got the green line the very next day. I mean, we were pretty bearish, and we went up and we got the green line the next day. Some of these other green arrows, we didn't get the green line, even though we were green for 4 days here. And you can see over here, you got the green arrow. That was in reversal. We'd have to go back a little bit further. Right here, so you got the green arrow and you got the green line just a couple days later because we went up so much. That's what we need to see. We need to see 3 green arrows, QQQ. Now we need to see a green line within the next couple of days, day or two maybe, to really turn the tide. Here we got it on that day, it turned green. But when it fails, like for example right here, it's because we never get the green line. So we need to be aware of that like right now, it doesn't look like we're due to get a green line because we're not rising very fast. This has not been that big of a run up to the upside in this 10 days. If you look at the 10-day rate of change, which is, it's been 2 weeks since those options expiration clusters, right? That low point there, we're up about 3.25%. That's not back over here at 10 days off of this low point, we were up 7.25%. So easy to get the moving average to turn up when you're up so strong. This is, it's been a pretty decent run for 10 days. These are all other 10-day rallies, and it appears to be like, okay, we might really take off here, but we were down 4% on a 10-day move, so to get 3% is good rebound. But you can see that's kind of where we failed here, and it's where we failed there on these failures of bear tags. Instead of the bear tag that reversed that sent us up, but we were pretty much at the same level of a 10-day return, but not off of the lows, right? We were, coming off of 10 days from over here. So we're susceptible, just like this 10-day window here where it was 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. So there's your 10-day window off of that expiration low point that we had at the time. It was about the same amount. It was actually a little bit higher then than it is now, and it failed, right? So again, that's something that we kind of keep an eye on here. So looking at the DMI, it's still not very bullish. The negative indicator is still above 25. The positive is at least above 20. It's not above 25 yet, but at least it's above 20 there. So that's a positive, at least direction, though not bullish yet. If you look at the RSI and the CCI, we're above 50. We need to get to turn this green. We need to get above 60, right? So we're obviously not there yet either on this. The CCI did get to above positive 150, so that's a good development. So again, the RSI needs to kind of confirm that move, but at least we're getting up above this 150. Now, granted, you can see over here we also got above 150 on the CCI. I got to 160. We did not get above 60 over here, and it failed, right? So again, that's the problem with these moves to the upside. They just aren't very strong when you're coming off of these significant low points. We'll come back to this chart in just a second. Let's look at the Ichimoku cloud. Again, we don't have a bearish trend, a strong bearish trend, but it still exists. So that's because we're still below -1, we're still above 50. So as of right now, we still have a weak bearish trend. We're still in the cloud. We're above both lines, so okay, but we're still above the cloud, right? You can see here we got kind of above the cloud, and it failed there, and we actually did lose the bearish trend and still failed. So we don't even have that yet, and still have a negative rate of change there on a 26-day basis, which is what that red line is telling us. Finally, if you look at the Bollinger Bands and the Keltner channels, again, we are not in the upper quartile, which we need to be. If we're going to be bullish, we need to get in the upper quartile. We're not. We're in neutral territory. The bands themselves are probably a day away from getting inside the Keltner channels. So we're about a day away from red dot. Now, that's great because red dots usually mean that we can change momentum from bearish, in this case, to bullish. But we need to, again, finish in the upper quartile. Ideally, we need to finish up above the upper band. But at least we need to finish in the upper quartile, close to the upper band, to really get this train going and get moving to the upside. Otherwise, as you see over here, we were even in the upper quartile and it failed. Right? In this one, we didn't get in the upper quartile and it failed too, and started a new leg lower to the downside. Let's look at today's intraday range. You can see we did finish above last week's high point. Positive, good sign. Higher high, higher low. The problem is, the idea is we started the day with a good, strong gap to the upside. It was more than 2 standard deviations. One of our biggest gaps to the upside of the year, right? It's only 2 others that have been bigger than what we saw. And that one finished with a 2% gain. And this one almost finished with a 2% gain. This one did not, right? So if you look back at February 22nd, for example, if I were to go back over here and go out a little bit further in time. So February 22nd right here, you can see we gapped up and we continued higher. We didn't fill in the morning, we just continued higher. That wasn't the case today. Today, we actually did fill in some of the gap. Here, let's go back to just looking at it short term. We did fill in some of the gap already, which is not a good sign. And we didn't really run away. In fact, we didn't even get above this morning's high point. So very unlikely that's a runaway gap. It's not a breakaway gap either. So which means more than likely it's a common gap, which means that more than likely this will get filled in. Now, granted, you got a good support at the bottom of this gap, so it might just fill in and bounce, and then we might get a runaway gap later next week. But again, a kind of a sign that we could have had a much better gap and runaway today, which would have led to a strong move to the upside the rest of next week, the expectations. And we did get a gap up, and it looks great. And we finished high. We finished near the highs of the day. Everything looks great, but it wasn't a runaway gap. And so again, a common gap means we're probably going to close down to 505, or at least get down to 505 from 511 right now in the quarter, sometime during probably this next week, probably early this next week, maybe even Monday or Tuesday of next week. We'll flirt with coming back down into this area. Again, doesn't look like we'll go lower because of how strong the support is, but you expect to bounce that support until you don't get one. So it doesn't guarantee. And we are set up for a breakout here. We're just not, I mean, we're below 50 now on the red line. So we're set up for a break up to new high point. It just would have been much, much better and easier for you to close, like, say, up here after gapping up and then running up to a 2% gain. That would have been the most ideal today. Today's range, as was mentioned, today's range was actually right about a little bit above average when you account for the intraday move. So we closed here at 505.03. The low today at 511. So we got about six points of range. 508 was the gap there. So we got about a little bit more than 3.5 points of range from close to low. So add on 3.5 to here, you're looking at about 7.5. So including the overnight trading, pre-market trading, we were above average. But the problem is, we had almost as much in range with very, very extremely low volume as we did in range after the market opened. And after the market opened, we didn't move. So all that range didn't move. And we moved during the other 3.5 points where there wasn't hardly any volume. So again, not the best there. The volume itself wasn't the best either, 72. We wanted anything below the moving average, we wanted to be strong and push us through. And man, we could have really had a good bullish day today, but you can see kind of how we're missing on some really important things here. If you look at the, again, we need to start, we'll start coming down, but you want bigger ranges when you are breaking through, below and breaking through this average. The volume you can see is really light. I mean, this is, you can see the volume was really light over here too, relatively speaking, and it failed, right? And until we got a big surge of volume, now we could bounce off of this surge in the range and the surge in volume. Here we got a pretty decent surge in range, but no surge in volume. So again, a pretty decent you can see, the evidence is piling up that there's a good chance that this fails. Unless things change drastically next week, it's a pretty good chance that this fails here. Again, I expect that it won't fail, but, again, we have to be aware of all this, evidences here that, I'm not too gung-ho about the bullish moves. Even though we did the long call trade yesterday, we're going to do an iron condor trade today. I'm not backing up the truck yet in terms of a new intermediate run for these reasons that we're talking about. Finally, let's take a look at the VIX. The VIX really dropped today, so it dropped well below 15. We're below 90% on the VIX to VIX 3M ratio, so that's a low level. Again, 85, below 80 is extreme. But the VVIX closed below 75. That's the lowest level the VVIX has been all year. In fact, you kind of have to go back quite a bit to get to a lower level than 75 on the VVIX. Here, let's pull up the VVIX. The VVIX itself, so again, that was the lowest level of this past 52 weeks at 75.5. So let me zoom out a little bit so we can get to where we're at 74.5. So here, 74.57. So we have to go all the way back out here. It was even lower than that right before the banking crisis. We have to go back to here, to the beginning of 2023 was the lowest level. And you can see what the VVIX did after. Remember, the VVIX and the VIX are pretty correlated with each other. So if the VVIX is going to bounce off extreme lows, you would expect the VIX will start to bounce too. So again, another red flag. Ideally, when you're coming off of a low point, an intermediate low point, you want them to be pretty high and starting to come down slowly so that you got some room to run. That wasn't the case. The VVIX dropped like a rock. And the VIX has dropped pretty considerably. Like when you look at the rate of change of the VIX, let's pull up the VIX here. And say, okay, how much has it dropped in this 10 days, right? The 10 days from that double cluster that we had on the S&P 500, over the double oversold cluster that we had. We're down 27%. That's a pretty decent amount, similar to what we saw over here. But again, the VVIX at a much lower level now than what we saw even then. So that VVIX is telling us something. It's telling us that this is a great break below the average here but we're already really low on the VIX. There's not a whole lot of downside left in the VIX because we just basically used it all up already in the past 2 weeks. So it just might mean that we have some volatile grind to the upside. Less bullish than what we saw coming off of that Halloween low point last fall. All right, if we take a look at what's driving this price action here today, you can see here, let's pull up just today first, and then we'll look at the week that was this kind of quote-unquote risk-on week. Again, you can see the weakness in the dollar continuing today, helping propel. In this case, it was Qs up 2%, big-time move in the Qs. But again, a lot of that has to do with the strength in Apple and its earnings. SPY up 1.25. Russell 2000 did not gain that much. In fact, the Russell 2000 actually underperformed TLT. So it kind of goes to show just how strong that was. Despite the weakness in bonds, the dollar, emerging markets and developed markets also underperformed TLT. But a good run in TLT, 1%, also means that yields were down considerably. We'll take a look at that here in just a second. Commodities were up just a little bit, but underperforming just about everything except for gold and the dollar. So three-headed monster to the upside, right? Let's zoom out here and look at just the week that was. And you can see, okay, by the time this week ended, the best performing asset class for the whole week was the emerging markets, right? And Qs were actually down going into today with the earnings that we've had earlier this week and the FOMC roller coaster right there. IWM is actually up going into today, and EEM was really up. Well, EEM finished the week up 3.25%. You can see IWM finished pretty strong. The Qs, with that 2% gain today, finished up 1% after being down 1% on the week. And you can see really the last couple of days, we started off with weakness in the dollar and helped stocks rally. Then the dollar rallied Tuesday and Wednesday before falling here Thursday and Friday and helping push things up over the last couple of days. So really big move. In fact, if you look at just the last 2 days alone here, again, the Qs, IWM up 3% or plus or minus. EEM's up quite a bit. The dollar's down a full percentage point. Commodities, bonds are up quite a bit, which means yields are down. So let's take a look at, we've been talking about these trends in the dollar and bonds. Well, there's your dollar move. Now, granted, we came off the lows of the day today, but that's a pretty decent move there, below the 30-day moving average on the dollar. If you take a look at like the euro US dollar, you can see it made a run to try to get above the 200-day moving average. Remember, this is by far the biggest component in the dollar index. It ultimately closed above the 30-day, but failed to get above the 15 to 200. So again, we're moving in the right direction, which would be bullish for equities if we can break through that. But you can see the failure there. The 10-year yields, another factor. It pulled down to 4.5% today. Again, did not close at the lows, which would have been below the moving average. But as of right now, we're kind of sitting there at the 30-day. Now we've seen the 30-day can act as a support level, plus or minus, right? And right around the 50, especially when there's a gap between the 30 and the 50. So again, is this a new beginnings of a move to the downside here, or is this, because again, a move to the downside would be very bullish for equities, whereas a bounce up would not be. Commodity prices have been kind of down a little bit, holding their 50-day moving average after getting above the 200 last week. Back down below the 200 and back, but holding the point of control in the 200 again. Rising commodities, generally are bullish and have a positive correlation with the S&P 500. But if you zoom out a little bit here and you go out to like a kind of more of a longer term correlation here, and let's go to a weekly. Then you can see like there's been times where it's been more negatively correlated, where rising commodities puts pressure on equities, right? And then we are positive, okay, and then we had falling commodities pushing up equities, and now we've been positive and we're starting to get back to negative. So it's okay. Are we going to a rollback down on commodity prices with a negative correlation and push the equities higher, or is it going to be vice versa, where this is the drop that we get on this and we rebound back up to the upside? So there's your bull tag that we're not really, we kind of fell down a little bit more, but then have stalled. The intermediate line is below its market sentiment, but now your near-term line is pretty close to crossing back above the intermediate line. So very important first part of the week. And big strong commodity move, big strong dollar move won't necessarily help here. We got the bull tag today, and then we had a big long lower shadow. So if we rebound here, short-term sentiment rebounds, and we go up, and 10-year yield does the same thing, it rebounds off of this extreme lows and bounces back up with what would be kind of like a bull tag there. Then you can see how, from a macro perspective, intermarket perspective, what would drive that failure. I did want to take a look at let's take a look here at some of our breadth indicators we'd like to look at. So here's another red flag in terms of how we might have a failure here. So let's look at the number of stocks are breaking above their 50-day moving average, especially because this is the one that breaks up first. So it went up today. That's a good move. It did go up, and this is the 5-day down here. Let's change this back to a 1-day, because when you really take off to the upside, on the S&P, we're usually breaking above the moving average. This index is breaking above its moving average, and it typically breaks above its moving average with a big strong move like that one there. These are 1-day returns here. That one there, this is where we failed, right? We got up to the moving average. We didn't break above with the big move, and it failed. And we kind of failed there, even though we did get a pretty decent move to the upside. It failed there because the big move here was actually got you below the moving average. By the time you got above it and through it, you weren't getting a very big move anymore. And then you finally did get a big move through the moving average here, and so forth. So a good rally there. So here, again, we're still below the moving average, and we haven't got a big move at all. Even this move here off of that low point wasn't that big, relatively speaking. We need to be in the 30s and 40s when we're breaking through the moving average. So that's what we need Monday, Tuesday, a big, strong breadth move to the upside. Get that McClellan oscillator here. Get that one bursting through above 35, so we got the 46 today. That's great. We need to move up closer to 100. Ideally, because again, we got negative 100 here. It would be really nice to get the positive 100 on this, this kind of breakout move through these averages, reverse this trend reversing move. If you look at the new highs and new lows, we like to get up. We got above 100 today, 175. That's a very positive development, well above the average, which is actually negative right now and still falling. Here's another. So the skew is another factor. It's below its average. It needs to get back up above. It flirted with that this week. It's still well below that, so we still haven't broken up here and really broken through to the upside. That's kind of when see, when you get above the moving average is when the skew rises, and when you really start getting bullish, the beginning of a bullish move. Here's another red flag. This is a really significant red flag, and that's the volume. Whoops, not this one. It'd be this one. So if you look at, for an example, back here, when we peaked on price, we also peaked on volume. This is money flow, so it's volume normalized by the price. So we peaked on the volume at the same time we peaked on price. And then you notice, if you could follow my cursor all the way over to the right, by the time you got over here, we got right back to that same level. Well, if you also notice here, by the price, we also got back up to the prior highs too. So the price and the volume, which is typical, rebounded to the same degree. Very typical. So far right now, the highest level on the volume profile was here on this cluster. A little smidgen higher, retested it over here. But pretty much when we got that cluster, that was the peak. We kept going up as the volume deteriorated. In fact, the highest high that we have here is right here. This would be on March 27th. That's the highest peak we got. So we got the cluster on March 1st. On March 27th, you can see even though we were at the highest close of the year so far, the volume profile had already started to drop. Lower highs, lower lows had already started to drop. Then we really dropped, and so did there. But here we are now with these double clusters and a 10-day return to the upside, which is not that bad. 3 1/3% is not that bad. I'm pretty much a bear tag across all the major indexes, coming off a double cluster, and the volume is like minimal. It's like barely higher than where they were. And if you go back to the last time we were at about this level, so which was about March 27th, or excuse me, March 1st, we closed at 512.85. Today we closed at 511.29. So it's the closest we got, and you can see we're nowhere near that level of volume. Nowhere near it right now. So when we rebound, we should be rebounding in volume too, and that's just not the case. That's a huge red flag. The McClellan oscillator is still in the lower half, so at least it's not in bearish territory anymore. We finally broke out of bearish territory, but we're not in the upper half, much less above 60, which is what you need to get when you're really strongly bullish. Is you need to get above 60, right? Get above 50 and then get above 60, and we're really bullish now. You got the dark green shading, you got a cluster to really solidify the move. You got a strong move in the bullish territory and the volume. Everything looked great there. Everything is not looking great here so far. Things can change, but if things don't change Monday and Tuesday, then we really got to take these red flags pretty seriously here, and that's probably the biggest one. One of the other biggest ones, and it's actually improving, is the rotation in the sectors. You can see your safety sectors are moving down pretty rapidly. They are green shading. They're moving down to the left. So they're losing momentum and losing relative strength. XLK is moving up to the right. XLY is moving up to the right. XLC is not quite yet, but at least it's not going down as much anymore. It's not going down as much as these others today. And if I were to look at the weekly chart and how things change for the week, so here is the weekly version. XLE, XLB, XLU, and XLP are still moving on a weekly chart in the wrong direction for what we want, right? So again, this is kind of a red flag from a long-term perspective, but at least in the short term, we have things moving up in the right direction. XLK, XLY, XLRE, which is kind of matching those. In fact, if you look at today's sector return, XLRE is kind of like, it's kind of become a cyclical stock along with those others. Here, let's take a look here at just those today here. So XLK, Apple, thank you Apple, XLC, XLY, but let's zoom out and look at the last couple of days, and you can see again XLK, XLY, XLC, XLRE, right? Those are the big winners. And then you have all the others, you have your safety trades, XLU, XLP, along with industrials and financials, materials there, energy and healthcare down at the bottom. If I zoom out to the whole week, that was this kind of relatively positive week, utilities is our biggest winner. All right, so as great as XLK has been, and XLC too for that matter, they were coming off of some pretty significant midweek low points to rebound along with XLY, but XLU is still the big winner on the week. In fact, if you look at the ratio charts here, we've been looking at a few of these ratio charts that are kind of correlated, either positively or negatively with risk appetite. We had that big breakdown a couple weeks ago on the 200-day moving average on XLY versus XLP. It had a good week, but we haven't broken through those averages again. We're kind of at resistance there. XLU has been so bullish, and it rallied above the 200-day moving average. It pulled back the last 2 days. It's still above the 200-day moving average. We need to pull back a lot more than that. XLK, which had broken relative to the S&P, had broken its 200-day moving average. It rallied, but it didn't get back above it. It rallied up to these moving averages where we could fail. So you can kind of see again, and then finally we look at QQQ relative to IWM quite a bit. It's still not back above these. It's still flat. The 200-day is still rising. We're not breaking back out, nor do we have very much room to break out before we're right back. I mean, we're pretty much already at extremes even here, but we've been sideways at extremes, and there's not a whole lot of room to get to the 2 1/4 level, which is right now the high end of this current extreme this sideways action at these extreme levels, with that long-term PPO still falling. So it's, it's been a good week, but it's definitely not a week that has like clearly reversed this weakness we've had, this 5% zigzag that we finally got, right? We had gone so long without a 2% drop, 27%, which is, a record amount, without a 2% decline. It was also pretty decent strong amount for not having a 5% decline. Well, we finally got the 5% decline, and we're not really breaking out. It's kind of like over here. We weren't really breaking out over here either. We finally started to. We got an 11% rally over a couple of months during a seasonal bullish time of year. This is a relatively seasonal bullish time of year right now for the S&P. It's obviously not the fourth quarter, so it's not as bullish as the fourth quarter is. But there's this is seasonally a bullish time of year. So that's the hope, that we finally just kind of take off to at least a divergent high point. It's not going to be another 27% run or a 19% run. It'll most likely be around 8, 9, 10%. And then we start to worry about what Q3 brings. But you can also, again, like we've been talking about, if we fail next week and don't break through, then we need to start taking these red flags seriously, as there's an increased likelihood we make a new leg lower. Like this will be a failed pullback bounce, and we might make a new leg lower down towards the 200-week moving average, right? So a pullback gets you to the 200-day moving average, and to the 50-week. A correction gets you to 200-week. So again, we can't. We haven't really got a pullback right now. It's kind of like over here. We started to get a pullback, we bounced, and then we got the pullback and down to the 200-day moving average. Here we started to get a pullback. Is it really? Are we going to do this kind of thing where we fail again? Like that's what we need to see next week, right? And again, I don't think we will. I think we'll bounce back up and start to grind higher. But we need to be aware of this kind of move that can happen within the next week or two, especially with the week after being CPI and the week after that being NVIDIA's earnings, and how bullish NVIDIA has been. All right, that brings us to our trade idea of the day. Let's pull up this chart here. All right, our trade's on Cardinal in the healthcare sector on Cardinal Health. It just had its earnings announcement. It was already bearish, had a couple clusters like the market going into expiration, has not rebounded over the last 2 weeks. In fact, I had a little bit of a bounce up on earnings, but then pulled right back down here today. We are the most below the moving average we've been all year, more than what we were with these clusters. We obviously did not get a cluster, but we came really close today. The market sentiment is almost in the lower half of the chart. You're going to see some pretty strong bearish, pretty mature bearish patterns on a lot of these indicators. We're flirting with breaking below, kind of similar to what we saw over here, the 40-week exponential moving average. Obviously, you have 3 red arrows. If you take a look at how red they are, we got the 200-day moving average here. We are well below these. I mean, we've got the cross below 30, below the 50. MACD is already very low. Even if the histogram is bottomed out well before, the MACD still hasn't bottomed out yet. Maybe today, we'll see. The stochastics is also diverging a little bit there. The DMI looks pretty mature. You can see we've had a strong, the ADX is up pretty decent levels there already, with the negative indicator high and the positive indicator starting to come up off of its lows. The RSI and the CCI, you can see down to pretty strong lows there on the RSI and breaking below minus 100 there on the CCI. Looking at the Ichimoku cloud, we have a mature bearish trend, well above 80 and well below minus 5 and way below the cloud. I mean, very mature in this move that we've been having on Cardinal Health. And you can see as well, we're going into an area of a gap in volume here below the cloud. But see, we're not breaking outside of the bandwidth, at the beginning of a move. We've already been going, right? And the Keltner channel here, we've already had strong momentum. So when you've already had a strong move and then you get a break outside the bands, then you worry about, oh, that might be kind of like an exhaustion type move, especially inside this gap. So what I decided to do was an iron condor on this trade. So let's come over here to its June options. And I sold the 20 deltas here, as low to the 20 deltas as I could get. I had to go $5 wide because that's how the calls are set up. So I had to go out to the 90 there. So it sets up the trade like this. Here, sets up the trade like this. And you notice my break evens where they're at here. For a full position size, right, getting about $435. If I put my break evens in the chart, then if we break out to the upside, we have to get above a pretty strong node and above the value area and back above these moving averages. So we'd be clearly reversing the trend back up to the upside. If we break it down, my break even on the downside sitting right on the point of control. And remember, we've already been pretty strongly bullish just to get to this point. To get below the 200-day, it's probably going to be difficult to keep going too much here. So we're probably going to start at least converging, if not going sideways. And that's hence the point. Like if we fill in this gap of volume, we make our money with this iron condor trade, and that's kind of the idea behind that. All right, well, that does it for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow me on Twitter and Facebook and like us there as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.